Ian, please introduce yourself and tell me a bit about Lowe's.
Yeah, okay. Well, I'm Ian Lowes, Managing Director of Lowes Financial Management. We're a 50-year-old firm. I've been at the helm for over 20 years now. Whilst we're a full-service whole-of-market independent financial advisor, staunchly independent, we have a profile, at least I have a profile in terms of structured products, which stems from the early days when we were very vociferously critical of certain structured products that were being heavily promoted in the market. We were issuing damning reports, trying to get journalists' attention to what ultimately became known as precipice bonds. But at that time and subsequent to that, we were trying to point out that the whole of the structured product market shouldn't be tarnished by some bad apples. So since then, I have ended up being on the other side of the fence, trying to raise awareness for the sector, because as an independent financial advisor, it's our job to search the whole of the market. And we shouldn't be influenced by some bad apples that happened in 2003 or 2008. Our job is to just sift through all of the noise and try and find decent propositions. So in doing so, we've helped shape the market, and we've become very influential in that sector to the point where we now design products in conjunction with providers. And they're designed to sort of tap into the market and just bring something new to the sector. So I've seen that sector and been very heavily involved with it for 21 years now. And it's gone from being sort of an interest to a passion to almost an obsession now.
Yeah, excellent. Yeah, great. Okay, so we can talk about the checkered past potentially of structured products just a little bit. Maybe you could tell me a little bit about start of the sector and where it is now.
Yeah, okay. The first structured products started to appear in the early 90s, and they were often issued by insurance companies as guaranteed equity bonds and equity participation bonds. The big change happened when HSBC came into the market, or as Midland came into the market, and started using the TESA rules to provide a cash investment which was participating in the FTSE. That made a huge difference to the perception. We then ended up with new participants in the market issuing what many cases became known as precipice bonds. These were contracts which, if things went wrong, you were losing at double the rate the market for. Now, anything that offers you 2 times participation in the downside is never going to be great. They might have had high headline rates of return, guaranteed income. I think some of literally the phrases, guaranteed income, 10% per annum. End of 3 years, you'll get your capital back as long as the market hasn't fallen by 20%. And if it's in some cases fallen by 33%, you're losing it all. These things being promoted at what we still saw as the top of the market in 2000, 2001, subsequently did transpire to fall by more than 30%. And people ended up losing some or all of their money, in some cases all of it. At this point, we then end up being regularly quoted in the press because we were the ones warning about it 2 years earlier. But of course, we get associated with a negative sector. But I remember having conversations with journalists who were ringing me up saying, didn't you say all these were bad? No, I didn't. I said some of them were bad. Some of them were really good investments. And over the years, we've seen that gradually improve. It takes regulatory intervention. So we have regulatory intervention following the precipice bonds, regulatory intervention following the collapse of Lehman Brothers, which affected 1% of the market, but dominated 99% of the headlines. We then end up with a situation where you get further regulatory intervention, further improvements in the sector, but not enough. Gradually see it evolve to the point where now I think it's a significant force to be reckoned with. There are very rarely contracts launched that we would say avoid these at all costs. And that's been the case for at least for the last 5 years. A big shift and we now have a sector which has got a phenomenal track record. There are very few investment sectors out there that don't have some sort of skeleton in the closet of the past, even including unit trusts. The early collapses of unit trusts, etc. You forget about those. The people who are dominating or are pulling the headlines for structured products and saying that they've got a bad rap or they're negative are just not up to date. It's 21st century. These are 21st century investments. And the performance of these is what it says it's going to be. And the past performance is exceptional.
Okay, great. So I was thinking, just before we delve into sort of the pools of structured projects, maybe we could tackle some of the limitations. So just as you see them, maybe what would sort of, I'm trying to phrase this generously, that hinder advisors from, tackling, like looking at structured products.
Basic resistance to change have always got to be accepted. If you are going to bring something new in, you need to bring in new procedures, new policies, etc. So let's accept that there is always going to be some resistance to change. The big issues about structured products generally are all gone by in the wayside, and that it would struggle to sort the wheat from the chaff. It's something that we did through structuredproductreview.com, and we did that preceding that website through our own website, by identifying which products were decent, which ones we thought were flawed. You no longer have that problem. All of the products are properly described. This is a tightly FCA regulated environment, but you need to spread your risk, as with everything else. So diversification is a key. One of the problems we'd had historically was you didn't have enough counterparties. You don't want to put all your eggs with a single bank, so you want to spread it out as much as possible. We now have typically 10, 11 counterparties participating in the sector each year. So that problem's gone to a large extent, as long as you're patient and you're building your portfolio. The structured product returns are typically capped. So if we see a runaway market or runaway inflation, whilst you are going to achieve the returns that you set out to achieve, because they've got defined outcomes, that might transpire to be less than it would have been had you participated in the market. Now, this is one of the things that structured products bring as well. It's that defined outcomes delivered at defined dates in defined circumstances with defined contingent capital protection. So you're buying something that you know exactly what it is and when it's going to mature in what market circumstances. But if you're buying 8% simple return per annum and it matures in 3 years, and let's hope the markets are up 50%, it's not going to disappoint, but it's going to disappoint by comparison. The inability to hold them on many platforms. Some platforms, obviously Transact, Novia, Nucleus, Hubwise, they will all allow you to hold structured products in portfolios. But if you're married to one of the more traditional fund supermarkets, you are going to have a problem holding structured products on that platform. Now, we don't hold structured products on any platform. We hold them off platform, don't have any platform fees as a result, have a monitoring system to establish, to give you all the things that a platform could give you at the best possible scenario and more, because none of them do it properly. And we provide that software out for free to IFAs who want it as well, just because we've built it and we might as well. One day I may commercialize this, but it's certainly no plans for now. So the platform thing does become a restrictor, particularly if you want to try and keep all the assets in one place. But you often can't do that. You might have a portfolio and a bond and VCTs, so you're already starting to spread out your assets. So these restrictions, these issues are something which is easily overcome. And I would suggest that for an independent financial advisor, it's something that needs to be overcome. Otherwise, you are disregarding a whole sector, and specifically a sector that the regulator did say at the onset of RDR was something that you needed to consider if you were going to be an IFA.
Yeah, fantastic, excellent. So let's just look on the other side of that then, and why should advisors be looking at structured products? Like apart from everything that you said, but could you expand on that a little bit?
If you're an independent financial advisor, whole of market, you are going to assess the whole of the investment universe. To ignore something which has clearly defined outcomes and is not that complicated or difficult to understand. Everything's difficult to understand if you're not going to try, but it's not that complicated. It's not that difficult to understand. And you know what the market is. Nobody knows what the market's going to do. If you're expecting the market to race away and never take another dip, well, you're not going to be anywhere near anything that's got any protection. You're going to be on a geared upside. If you're like the rest of us, you don't know, and you don't know, then a structured product will give you some definite outcomes in different market circumstances, even in falling markets. So we're all investing with a view to making a return, and that return should be beating inflation, providing us some return. If you're looking for double-digit returns regularly, you're a speculator, not an investor. If 7% and doubling your money over a 10-year period is adequate, and it should be for most people, then structured products definitely deserve some attention. As I say, it's to me, it's not complicated. I live and breathe this stuff and have done for a long time. But when we sit down and we talk to people who have been skeptical or just don't understand it and have never been near it, when the penny drops, it really does drop. And they then instigate some business changes within their organization. One of the unforeseen consequences of using structured products that we've experienced is the impact it has on client relationship. If you've got a series of structured products that could mature each quarter or even just every 6 months, contacting the client to say, good news, that contract that we put in place 2.5 years ago is maturing today with an 18% return, despite the fact that the FTSE's 4% down. Can we come and talk to you? What would you like to do? Do you want to keep some of the proceeds? Do you want to reinvest some of the proceeds? And would you like to introduce me to any of your friends and family? There's no better conversation to have. And while we're there, we do the periodic suitability on the wider portfolio, because the structured products only represent a small part of the portfolio, but it's the structured products that the clients concentrate on. Because they know that if the FTSE is above 6,800 points on the 25th of July, say, this investment's going to mature with a 20% gain. If not, maybe a year later, it's going to mature with a 28% gain or thereabouts. That's what they focus on, which means that they can avoid and they ignore the daily noise of the rest of the open-ended portfolio, which any advisor will appreciate is a good position to be in. The clients need to be long only, ignore the daily noise, they can focus on the structured products. They might have bought one in January 2020, FTSE's at 7.4. It's going to give them 10% for each year it's in force, maturing on the first anniversary that the FTSE's back up at 7.4. That currently doesn't look likely in the short term, but these things weren't going to mature in the first 2 years anyway. But if you've got a 10-year term and you need the FTSE to be back up to where it was in January last year at some point over the next 10 years, and on the year it does, you get 10% for each year, that's a good conversation to have on a flat market. So really have been fundamental in the relationship with clients by accident more than design. So I'd definitely encourage the consideration. Often we speak to people, they do get it, they start to use them in their own portfolios. And I have no objection to that. I would say, do not recommend anything to a client unless you're prepared to invest in it yourself. So we do see advisors starting to put them into their SIPs and starting to put them in their own portfolios before then moving on to clients. We hear anecdotal evidence that once they have started that relationship change is quite significant.
Yeah, just on that, maybe you could tell me, have a lot of these conversations changed recently? Because I don't know, over the last year we've had a very sort of buoyant market. Is what are these? Tell me a bit about. Give me an example of some of these conversations, maybe.
You would have done very badly not to have done very well out of any investment over the last 12 months. So let's accept that the structured products that you bought in April 2020 have capped returns. Now, when the market's just plummeted to 5,200 points and you have no idea where it's going from here and whether we're going into a full global lockdown, we're all going to die, you know, it's April 2020, we have no idea what's going on. Do you want to be going all in on the market? You know, brave men do and successful people do. But if you can build in some capital protection so that you're not going to lose money on that capital in terms of a nominal value, unless 10 years later the market's 30% lower than where it was then you're buying some comfort. The contracts that you might have bought at that time would have been offering you, say, let's just say it's 10% per year simple. We know that in 2 years' time, as things stand, even with a dramatic fall from here, those investments are going to mature with a 20% gain. Not as much as you would have had you bought the market, bought full open access, you could have been out now with more than a 20% gain. So you are buying something and you're paying for some protection, but you're also paying for that peace of mind at the same time. The conversations with people do change in that the evidence that we've now started to produce from all of the sites that we've been operating in, we research every structured product that's been issued. So our database has over 7,500 products. And we've started producing annual performance reviews, 10-year reviews, reviews of particular sectors. that has led to changing conversation. Because much as I could say to you, this investment will mature in 2 years' time with a 20% gain if the FTSE is higher, what's happened in the past? You can back test that particular contract in any for any piece of history using historical data. But when we actually present the fact that out of the last 1,000 FTSE linked order calls to mature, all but 8 of them returned again. And the 8 that didn't return again just returned capital. You know, the review of the decade that we did for the period 2010 to 2020, we reviewed the evolution of the sector for that period, published that free piece of research. 4,444 structured products were issued, 3,895 of those matured, and of those maturities, 60 made a loss. And those 60 out of 4,444, 1.5% of all plans issued or that matured had made a loss. They were ones that we'd steered clear of. We'd identified these are linked to multiple shares as opposed to a mainstream index, etc. They were easy for us to say, look, that's a high risk investment, stay away from it unless you're a speculator. When we start presenting this sort of data now, and we have been doing this for 5 or 6 years, people are starting to take note to the point where you will rarely find an advisor who will say, I wouldn't touch structured products with a barge pole, which is what you used to get because they once heard that somebody lost some money because one of their products was linked to Lehman Brothers. Now, the whole Lehman Brothers thing is another factor. Nobody should have lost all of their money through the collapse of Lehman Brothers. Nobody should have invested in a structured product without knowing it was backed by Lehman Brothers, the same way you know it was backed by Morgan Stanley, etc. We steered clear of Lehman Brothers for much of the period they were offering products, which obviously I'm grateful for. But of the ones that we've tracked, the best case scenario is the return on capital was 97%, and the worst case was something like 74%. So you got 74% of your money back. So you didn't lose it all. Granted, it took 11 years to get there, so it was far from ideal. But the concept of if the bank goes bust, you've lost all your money is one that you've got to accept because you don't know what the recovery process is going to be. But ultimately, it's not as bad as it could be. You'd just rather avoid it. Again, why you would diversify counterparties. So all of the stories, all of the concerns that people used to throw out and say, look, I don't use structured products because they're complicated. Well, it's your job. Or because of the counterparty risk. Well, do you really understand what that is? Do you think Barclays Bank is going to go bust? And if so, where are you investing? Is HSBC going bust at the same time? And Morgan Stanley and Goldman Sachs, and are they all going bust? And where are you investing? You know, do you have some chickens? So you know, these things need to be assessed. You need to accept the risk, but you need to understand exactly what that risk means. The back-tested probability of most of these plans is 90 to 100% performance on a back test. Now, you are accepting the risk that the past isn't going to be as good as the future. That's the point. Otherwise, everybody would be doing it and you wouldn't need your money in the markets. But the fact that you still end up even on a forecasted probability of a 90% gain or 90% likelihood of a gain and a small potential for a loss, compare that to whatever else you're doing and ask yourself whether this is something that is going to outperform what you're doing elsewhere. And have you got any idea what you're doing elsewhere is going to give you in terms of returns? You know exactly what the structured products are going to give you. I have no idea what the rest of my portfolio is going to produce over the next 5 years in any market circumstances. I like to think it's positive, and historically it has been, but I know exactly what the structured products will give me.
Yes, that line is, past performance is no indicator of future performance, of course. That's actually a question. What weighting is structured products in your portfolio? How much does that make it up?
In my own, did I say I was obsessed?
Yeah.
I have a heavy weighting in structured products. It costs me nothing to acquire, so therefore I can transact quite a lot. But I have significantly more than 50% of my portfolio exposed to structures, and that has played out very, very well for me in the past. I'm also fortunate I've had some Tesla shares, and they've changed the value of my portfolio quite considerably, so it's changed the percentages. There is a degree of speculation goes on here as well. That's not for clients. There are some myths. There are some myths, and one of the strongest myths is that you shouldn't have more than 25% of your portfolio invested in structured products. This is a myth. And it's considered to be a rule. It's not a rule. It stems from some research that the regulator did following the collapse of Lehman's, where they investigated the practices of the 11 firms that were responsible for the sale of most of the Lehman-backed products. And they identified good and bad practice. And one firm had randomly selected that 25% should be the maximum exposure to structured products in a portfolio. That was then used as a test when they did their review of structured products sales in the market and asked whether the advisors had more than 25%. People went into a little bit of a shock. Is this a limit? Is it a rule? It was watered down to suggest that this was a level at which you should consider greater suitability assessment, which I think was a watered down version, because I think you have to consider a suitability assessment for every level. So this 25% sort of became an industry norm. I did some research last year to properly assess the outcomes of all the structured products and what those products had returned versus what you would have got had you been in a tracker fund and in a bond portfolio. And we then put that together and ran modern portfolio theory analysis against it. What that found was you were better off having more than 25% in structured products than less. It was a very crude and simple analysis, but there is no hard and fast rule. There are various factors. Like I say, if the market races away, I need my long only portfolio to go with it. I don't want to be held back with 10% returns or 8% returns if we have a market that's doing 20% per annum because all of the quantitative easing fuels inflation. We know that we don't know. But certainly I would say that, that a quarter of a portfolio exposed to structured products is going to give the client something to focus on. I'm assuming we're spreading the counterparty risk and we maybe haven't got more than 10% exposure to any one bank from that element. We've probably got a series of order calls there that will be maturing at different times. That 25% will become the bit that the client focuses on. So you can get on with managing the rest and make that a long only portfolio whilst looking at the next maturity date, having that meeting with that client when that happens, deciding what to do with that money. So yeah, the 25%, not a maximum, not a minimum, but certainly a good starting point.
Yeah, really interesting. I love how you're talking about conversations that advisors can have with their clients as well. It's a really good point to make, because that's what the whole business is about. So yeah. Good point. Okay, so I've got a standard video question for you, which is with the three. Which is if you have three key messages for advisors. If you have a message for advisors, 3 key points, please fire away.
Right. Okay. First of all, it's 2021. It's the 21st century. Start considering 21st century investments. They're not necessarily all going to be perfect, but they should be properly described, easy to understand. Have a look at structured product review, get a look at something like the 10-10 plan, which is one of the ones we've helped create and have marketed. It's a good starting point to get your head around. We all want to invest with the best fund managers and the best investment managers, but ask yourself, are you likely to be able to hire a better investment manager than a multi-billion-pound investment bank? Why don't you tap into some of their expertise, because they're not stupid. They're quite happy to give you these returns. They're going to be making a decent return at the end of the day, providing they manage their book properly. So I would suggest really do have a good look at structured products. They are something phenomenal for a client relationship. They're one of these things which, as I say, unexpected consequence was proven very beneficial. On our last client satisfaction survey, we had 96% of our clients rating us as good or very good on investment performance. That's in no small part down to the structured product performance. Obviously, we do very well elsewhere, otherwise we wouldn't be picking up good ratings. But certainly, it's a significant part of our relationship and the feedback we get. So yeah, register on structured product review. Take a real good look at it. 21st century, and look at the past performance. We've got massive amount of research that we've published. So I've got this 10-year review. I've done a review of the last 1,000 FTSE 100 linked order calls, the first 1,000 FTSE 100 linked order calls to mature. We have annual performance reviews. We've just done a 5-year annual performance review. Just to pull some figures from the 5-year annual performance review, I'm going to talk about order calls because they are the mainstream of the sector now. The vast majority of structured products listed are order call structured products. And there's a logic as to why it's grown to that. But the capital at risk structured products autocalls that have matured in the last 5 years, the average return is 7.44% per annum. Now, as I say, you're wanting 12, 15%, go and invest in emerging markets, etc. But if you're looking for consistent returns that clients understand what it is they'll get and when they'll get it, in what circumstances, you don't have to make excuses for a fund manager. Now, you might still have to make excuses for the fund manager for the rest of your portfolio, but as I say, this is the bit they tend to focus on, so you can get on with letting the fund manager do their thing for the long term. And of course, I'll plug our fund, because all of this knowledge comes into a fund called the UK DSF, the UK Defined Strategy Fund, ukdsf.com. That's got all of our expertise in a portfolio form, which can go on platforms, etc. So you asked for 3, and I must have given you 5 there.
Excellent, excellent. The more the merrier. Fantastic. Well, my last question is always like, is there anything you'd like to add? Is there anything that you want to get across to advisors? Anything in particular? No?
I'll happily talk about this subject all day. If you know, I know everybody says this. We have people ask us, well, what is your interest? We do have an interest in that. We have got to the point where we're using our knowledge and expertise to launch a fund, design products in conjunction with providers, of which we do potentially get a share of their margin if they make any. So I do have an interest, but by all means, pick up the phone, drop me a line. I'll happily chat you through and explain all of the potential pitfalls. I'll counter the arguments and show you why they're countered. I've got thousands of articles covering this and lots of research. More than happy to help people.
Brilliant. Excellent. Excellent. Ian, thanks so much for talking to me today.